It is August 12th. It's a Monday. And of course, this is the video log that takes 30,000 to a million. It's definitely going to happen. And after I take you through the account real quick, I'll just show you what's happened today. I want to talk about bonds out of all things, just because it's in the news, and there's a really big spike in bonds right now. The yields are really, really low on the 10-year and long duration bonds, so it's kind of making the headlines. And I want to talk about some of the dynamics, how the bonds work and their yields and how that's related to the price, as well as what some of the implications are to the overall economy, to the government, etc., and to you, and how that relates to long-term option selling. All right, so I'm gonna go on the account, show you what's going on. So this is the all-time daily chart, down $200 or so, sitting at 60,500 or so. Here are the options, all the negative numbers. Hopefully will go down to zero if everything goes right. If it doesn't, that's fine too. Apple is down $74. Quick look at Apple here. It's sitting at $200, which is exactly what my put and call options are sold at, which means that if it stays like this for another 6 months, then I will be collecting all that money, which is $4,339 exactly. So that's about it with Apple so far. Goldman Sachs recommends services companies, does not recommend Apple. There's an article that I read today. But that's fine, even though Apple has services. So we have Main Street Capital at $28 gain. FAX, it's Asian Pacific dividend funds down. Uranium stock Energy Fuels is actually gained $63 from me today. I have a total of 1,170. A lot of options in play though. So if uranium keeps rising to 215, which is my average buy cost, it will reduce all this negative to neutral and erase most of this. So I'm kind of leveraged on Energy Fuels, you could say that a little bit. Okay, let's see. URG is flat. Cameco is a stock that I wanted to cover real quick. Average cost is a little bit over $10. 500 shares, a lot of money tied up in this. So if Cameco goes up to 10, all these numbers will go down to 0. So I'm looking at a gain of about $1,200 for if it even reverts back to what it was in the beginning of the month, or even less than that. And here's what the 1-year chart looks like. This is the 5-year chart of Cameco. I mean, it's been this low before, and it's not really at its all-time low. I think it's gonna bounce back. I said that last time, and it's kept going down a little bit, but it's kind of bottoming out here, and I can't see it sit here for very long. I think it's gonna have a correction, and when it has that, hopefully my options will expire and I'll be able to profit again off of this company, betting on its moving sideways for a long period of time, which is kind of like the point of option selling. All right, so I'm going to talk about bonds and why bonds are, some of the reasons why bonds are so important, and first the correlation between the yield and the price. So bonds travel inverse of their yield. So as their yield goes up, their price goes down, and vice versa. And why is that? Is because of supply and demand. So let's say, for example, that you have an asset yielding you 5% per year, and you say, oh wow, that's so attractive, and everybody has that same thought, and all of a sudden, you have everybody pile into that trade, and now it runs short on supply. There isn't enough. Okay, so the yield that it pays starts going down, right? People who are offering the debt, in this case the US government, can offer debt at lower percentage now. Okay, so the new issuance of debt is at lower percentage, and so and the price of the bonds goes up because there's so much demand. So the price goes up, yet the yield goes down. All right. Now, if you buy directly from the treasury and you're not trading it out on the open market, the bonds, then you have that locked in. So I actually used to buy bonds directly from the treasury. So once you buy the bond, you wait till the expiration. Let's say you have, I'd do something like I'd pay $990, and at the end of a certain amount of period, I'd get 1,000 back. Okay, so I'd be earning an interest on that $990, right? So that's kind of how it functions. And but when you're in the open market, like on Robinhood, for example, so let's take a look at what was it? LTH was it? No, LHD, 10-year. Whoops, that's not it. Let's just do this. 10-year to 20-year Treasury bond. And so you can see how the dividend yield here is 1.83%, and it's had a nice spike today in value, which means the yield's been going down. It was a lot higher. It was almost 3% at one point. Now, if I pull it out to a year, you can see this huge 14%, more than 14% appreciation on the 10 to 20-year Treasury bonds, and the yield was much higher back then, a year ago. And now this is the 5-year, and you can see it's a similar appreciation over 5 years. So this is a fairly flat graph because bonds have been in a really big bull market over the last 30 years. Robinhood won't let me extend that to 30 or more years, but it's been a really, really big bull trend. So the yields have continually dropped in the United States as well as abroad. Like all the developed world, Germany has actually negative yield rates, which is a really crazy thing to think about. It's like letting somebody borrow, it's like telling someone, hey, here's 900, here's $1,005, and you can pay me back, but I'll only take 1,000. I don't want 1,005. I'll just take 1,000. That's good enough for me, And you can keep that extra $5 as a tip for using my money in the last 2 years or whatever, which is kind of ridiculous, but it's a reality right now. I think I read an article, is about $15 trillion worth, equivalent in dollars worth of sovereign debt out there is yielding negative interest rate, which means the quote-unquote investors or the creditors are actually getting gypped, right? They're losing money literally by letting somebody else use their cash. So you'd be better off literally sitting in a pile of debt. I'm sorry, a pile of cash in your bedroom, like behind, underneath your mattress, just keeping cash. It's better than investing in that $15 trillion dollars worth of government debts. A lot of it is German, a lot of it is European, right? But some people are saying that we could be looking at this in the United States as well, and this has a lot of implications, and which I kind of wanted to touch on today, which is the stock market. I mean, as the yields go down, this is kind of like what the rate of interest that the 10-year gives is. So there's like an amber alert. Is endangered elderly person. So the 10-year rate is the rate that everybody measures everything against because it's considered the risk-free rate, and for many other reasons as well. It dictates the interest rate levels as well as the rate that the Federal Reserve sets, and they play around with the short-term interest rates, and the market plays around with the long-term, but the Fed can also kind of control the long-term as well, and that kind of puts a price on borrowing for not just individuals but companies and other governments, and it plays a really big role in how successful a project can be for a company. For example, let's say you're into real estate and your project is going to be profitable at a 2% interest rate, when you borrow the money, but it's not profitable at 3%. All right, which is the case many of the times, right? You're not going to build that project if your cost is too high to borrow. And so it has a really big effect on the economy. That's just one example, right? But also lightens debt loads on people and reduces debt burdens and improves operating cash flow and stuff like that for companies as well as governments, and relieves government debt crises. But it also has other effects, like it incentivizes people to borrow, and if interest rates eventually do rise, then they'll really be underwater and in trouble, and there'll be a big debt crunch, kind of like there was in 2008. So people are afraid, to borrow, um, because that might happen. And so there's so many people willing to lend their money and not enough borrowers. So this is the kind of crazy stuff that happens nowadays. But I personally believe that there's no reason why, since the central banks have so much control over the interest rates, why the interest rates won't stay down here for almost forever, right? The only way that the interest rates will move from here is if the market forces the hands on the central banks through ways of inflation. But in my personal opinion, and I'm not technically an economist or anything like that, I don't think that's going to happen because of the way default is built into the system, and there's a natural destruction of money that occurs through the fractional reserve system. And so and banksters always have to fight, right? The banksters always have to fight that destructive force by issuing new credit and new credit and new credit. So it's kind of like trying to drown debt with, it's trying to drown debt with more debt to cover up the defaults. So it's going to be basically a perpetual credit issuing cycle, all right? And negative interest rates are probably here to stay in a lot of parts of the world until the market just goes bonkers and just requires a new monetary system, which a lot of people have been predicting for many years. It hasn't happened, and I don't think it's going to happen for some time. Eventually it will happen. There's been a regime change for the monetary system once roughly every 40 years, sometimes more, sometimes 100 years. This one's probably going to at least last another 10, 20, 30 years, I think. But we'll see. I might be wrong. I do hold some gold just in case something crazy like that happens, but not through Robinhood. I just have some physical gold. But that's not what I'm focusing on. I want to focus on making money in this current system. All right. So I kind of went off topic a little bit. I started talking about yields and bonds, but so let me go back into this and just take a look at the 30-year. You'll see how the yield is a little bit higher. 30-year bond. I think it's TLT actually. Yeah, it's TLT. So it's, you can see over here, it's 2.55 yield dividend, which is a lot higher. And here's the 5-year chart, it's 23%. 1-year chart is going to look pretty good too at 19%. So this bull market continues in bonds. Another reason why people buy bonds, because they consider it risk-free, because the chances that the U.S. government will not be able to pay the interest on the bond is extremely low. And so, because, they have the Federal Reserve, they basically have their own printing press. And so people lend them money because they want to receive that, and they think that that yield is going to be more than inflation, so they can collect real interest rate on their cash. But even if it's less than inflation, it's better than holding it in the bank, at least in the US, not in some parts of Europe. It's better than just having it in your checking or savings account, because your checking and savings account will erode in purchasing power, whereas the treasuries or the bonds will erode less than if you were just to leave it in cash. So many investors prefer to keep it in the bonds. There are such things as inflation protected bonds. Let's see if I can find them in Robinhood. Inflation protected tips. Yeah, they're called tips. And let's see how they're moving. They're moving in a similar fashion. basically looks the same as the bonds. But so what that claims to do is to lock in a yield of that's inflation protected. So you can see over here the yield is a little bit higher. But the thing is that the yield, the deflation has to be decided by someone, and is decided by the same people that issue that debt. Okay, so they have an interest in understanding inflation. So because they don't want to lose money in this trade, right? It's kind of like giving yourself a bad rating on Yelp. It's like giving yourself a 1 star. It's not going to happen. Okay, so inflation is always a little bit understated, and it really doesn't give you much more protection than regular bonds. So I'm not a big fan of tips. If I were to buy bonds, I'd just buy bonds outright. I do hold a position, as you probably know, of emerging market bonds, which pays a pretty good yield. So if I go over here, it's called PCY is the ETF that I use. ETF, of course, means exchange traded fund. And here is the yield. Where's the yield? Oh, there it is. It's a 5.05% yield, which is considerably higher than the US yield. Of course, emerging market bonds are a little bit more wild. Well, actually, it doesn't seem so on this graph. The US Treasury bonds were much more wild, actually, over the last 5 years. Okay, so I've actually received some payments over here, and you can see how they vary. So on May 31st, I received 21.91, June 28th, 21.74, a little bit lower. That means that it went up in value, and now 21.81, which means it went back in that value a little bit. So we should have like a little peak over here if we look at the graph. All right, and over the last 3 months, it's kind of what's happened. It's a little bit lower here than the peak, although it's kind of a steady grind upwards, which is good. I'd rather have the appreciation in the bonds because the yield depreciation is very modest. As you can see, these are all in the high 21s. So while I'm earning $300 in capital appreciation, my dividend yield hasn't dropped that much. In fact, it's only dropped 10 cents since I initiated the position. So that's actually really good. I'm really happy with holding the emerging market bonds at this point. And if there is a big stock market crash, I would want that money in order to buy some stuff up and hopefully ride the rebound as central banks pump money into the treasury market and chase money out of there and force people to buy stocks and other assets in order to get yield, and therefore boosting and quote-unquote goosing the stock market. And these are some of the reasons why I'm not bearish on the stock market long term. A lot of people are afraid that the market is going to drop due to poor fundamentals, and that's warranted. But this kind of scenario only happens when we don't have direct control over the monetary system by central banks. And this is a very direct control. And the central banks have kind of learned their lesson, and they know what's good for them, and they're going to pump money into the economy. There's no doubt about it in my mind. So even if there is a crash and a correction, it's going to be swiftly reversed by the powers that be, meaning the monetary gods of central banks, and we're going to see gains once again. So that is my view on the treasuries. I don't have interest in buying treasury bonds. Maybe some emerging market bonds that have high yields, and the reason is because I just don't think they'll beat inflation. I think inflation is going to be over the long term higher than the yield of the bond. So I don't really have any interest in holding bonds except for price appreciation, which is kind of speculation, and it's not really my market anyways. So besides short-term treasury notes that I can just keep my money in temporarily, like I did with that $3,000 just a little bit ago before I bought some Apple, I really have no more interest than that into buying treasury or any kind of US debt at this point, or European, especially European. Like, nobody should be buying European debt. The only central banks and banks are required to buy their debt, and that's why it's bid up so high. But it really makes no sense for an individual investor to buy Euro bonds, right, or European bonds. They'd be better off just sitting in literally just cash. Okay, I think that's it. This video's run really long. I feel like I'm blabbering at this point. So I'm gonna end it right here. Just wanted to update what's going on, and I hadn't made a video in a few days over the weekend, so I wanna kind of explain and share my thoughts on some things. Now that the bonds are in the news, I wanted to give my take. But anyway, hopefully, I didn't even talk about the precious metals market. It's continued to grind higher, and the miners have not caught up, which is really kind of worrying me. But we'll see what happens. Maybe the miners will shoot up higher really in a large way, or the metals will correct, which is what usually happens when the miners don't follow through, is the metals correct. All right, that's it for now. See y'all later. Peace out.